Thank you. And for me, it's a pleasure to come onto the platform, and speak to you. So just to set the context right, and you very rightly said, we are living in a world where COVID dominates almost all the discussion. So today I thought I would just give you a perspective of where we see where as a VC I see the world during the COVID times. Give you a feel about the VC industry evolution in India, because it's still at a very nascent stage, and talk you through comparing VC as an asset class vis-a-vis some other asset class. And in the end, just touch a bit about Unicorn India Ventures, our first fund, which is already totally deployed out and having a good performance. And then the second fund where we are in the midst of fundraising. So fundamentally, the objective I thought for all of us was to speak about this new emerging asset class. So just quickly to give you a view about where we see in the short term, there is going to be stress for the startups. A lot of them have recovered after the first bout of COVID, but having said that, given that the lower growth in global economy, lack of capital investments, the obvious fall in demand of non-essential goods, these are definitely going to have effect in the startup community. And we, as a VC fund, and not just us, almost all VC funds have gone into the companies and have told them to preserve their cash flows, have a survival first strategy, and which is already, to be fair, have panned out in the last 1 year. And within India, we were looking ahead to a good run this year, but for the second crisis, which has now come into the fore. We see a lot of consolidation happening within the industry, and we've seen that over the last 1 year. And a lot of these consolidation is driven by, quite a few cases by the investors themselves. The interesting thing that we are seeing is, while there is lesser VC money for new ideas, the companies that are doing well and are able to scale up, they are garnering a lot of capital. Within our fund itself, we are investing back in the successful companies. At the same time, I must say, even new businesses are getting invested, but the mad rush that was there into 2017-18, that has sort of taken a backseat. So as expected, over the next few quarters, we aim to see some of the residual effects there. But overall, I think the good companies will not only survive, but also thrive. I think one of the advantages that as tech companies we are having at this point in time is, because of COVID, more so, a lot of the industry is moving towards a light touch model, and technology is driving a lot of these decision makings. And while, of course, from a larger perspective, it is absolutely heartbreaking to see what is happening, wearing an absolute focused tech VC hat, I think most of our companies have in fact had some of the best runs during the last couple of quarters, simply because the digital disruption and the digital absorption that would normally have taken 3-4 years have happened in a couple of quarters. And we are seeing this right across our portfolio, and even in other sectors as well. So some of the sectors we see actively growing are health tech. We've seen that happening. We see ed tech as another area. I think my personal take is, in ed tech, the big players have already been established, and I don't see any new big player coming in, but there's going to be a lot of consolidation within the industry. Fintech is one of the most buoyant areas. We are actively investing in fintech as a fund. Within fintech, also there are areas like digital banks, digital lending, which are seeing an absolute upswing. Very interesting credit models are starting to come across in the distribution area within fintech. So fintech is a very active growth area which we are seeing. Given the fact that the changes that the government has made in the farm laws, and the fact that the rural economy after the first lockdown was the one which was enabling the country to come out of the recession, so to say. We see agri-tech as another big focus areas, especially things like core field, things like logistics from the straight to the consumer. All of these things are big areas we see. Two other very, very interesting areas which we are starting to see is in GovTech. Our definition of GovTech is where you start to anything that is related to the regulatory framework, both of the government and allied areas. For example, Supreme Court's allowing summons to be sent over digitally is something which was unthinkable before the COVID times. I mean, during this time, we have signed digitally, we have signed stamp papers, doing investments in private companies. All of this was unthinkable. So large number of innovative models are coming within that. Collaborative technology, we don't have to say. I mean, we are doing a Zoom conference using the highest end technology, which even a year back, none of us could imagine. So collaborative technology. And another very interesting area where we are actively made an investment and looking at is this whole area of gaming and esports, because our personal view is going forward, sports industry, events industry is going to be very, very different. So the latent need that people have of engaging will be more digitally through gaming and esports. Even this year, obviously, Olympics is not going to be held. People are now talking about dropping an Olympics and going straight into 2024. This didn't even happen during the World War days, but that's where we are living. So I see esports as another big area, and all of this are being, fast forwarded by the COVID effect. I think some of this is well known to most of us, but still I will touch upon it. Why we see India being able to lead the charge in this whole digital world, in a post-COVID, higher growth digital world. We all know of the Aadhaar rollout that has taken place, the BharatNet, which is actually, we can see now, large number of broadband subscribers. Forget the mobile phone penetration, but even the internet penetration today in India is drastically increasing. We obviously see, because of the global international political pressures, a lot of countries looking inwards for developing their own technology. This we see is having a positive effect in India, where consumer internet companies are starting to come, which was unbelievable. So an Indian equivalent of a Twitter is already out there making a noise. We see more and more of this happening as the world in a post-COVID scenario starts to develop a protectionist environment. Broadly speaking, and we all know it because we all live and breathe this within India, the digital penetration in India has increased manyfold. This is driven primarily by the drop in the price of data, led by Jio and the other telecom operators. Although in the last quarter, the price has gone up a bit, but still India today, after Israel, now is the second cheapest place. It was the cheapest place till before the price hike. It is about 4 times cheaper than US, 5 times cheaper than London. So the low cost of data, followed by the government push of a digital India, and the availability of cheaper Android phones, smartphones, this triangulation has led to a huge digital adoption in India. And today, India's digital adoption growth exceeds that of every other developing country. I think this is a very, very interesting slide, and I'm sure most of you are aware, but for those of whom, coming into the startup ecosystem is something new. I often face the question from first-time investors as to what is the value, how does valuation work? What is the Series A? It all keeps happening. Why do these companies not go to an IPO? What typically happens? So this is a classical chart of the early stage startup ecosystem. Initially, you obviously have the angels, the friends and family, the seed capital. That time the companies are just finding their feet. They are working on an idea. Co-investors are, co-founders are getting to know each other and coming up with the idea. So that curve, the red curve that you see, is basically called in our parlance the valley of death, which is where we see 80-90% of the companies fail. And then slowly, the companies start growing on, and as they grow along the various metrics of growth, they start getting various funding rounds. There is no definition of these funding rounds. These are very loose words. Rounds can be a Series A round, can be anywhere between $2 million to $7-8 million. There's no fixity in these, but fundamentally, the crux is that after a few years or few months, as the company progresses and business metrics are met, more and more funding starts coming into the company and the companies grow. A big part of it now is very few startups have been able to IPO in India. Literally, Zomato will be the second or the third one who will try to IPO over the next few weeks. One of the main reasons for this is the fact that in India, the IPO rules have not kept a pace with the startup world. You still have clauses where the founders have to have 25% equity. You still have clauses where the company has to be profitable. This doesn't define the startup community, which is why companies like Make My Trip and all of them, they flipped their structures to Singapore and then started to list overseas. One very interesting thing which the government has done in 2020 was the fact they came out with a rule that an Indian company doesn't have to IPO first in India, they can directly IPO abroad. And we see in late 21, 22, 23, a large number of these pretty scaled up early stage companies looking at the US market for IPO. So this is fundamentally where the startup ecosystem, how it goes. Unicorn, as we typically come where we have said break even, that's the area where we come in to invest. We position ourselves not as the first investor, but as the first institutional investor. So we start backing companies after they've been together for founders have been together for about a year, 2 years, the minimum viable product is out there. That's when we put in the first check to invest in the companies. I thought I would just briefly touch upon the VCs as an asset class, just to give you a perspective. In India, in 2019, the amount of invested through the VCs was 10 billion. In 2020, it was about 17 billion. Most of it obviously goes into the much later stage rounds. About 70-80% of it are in companies whose valuations would be more than $500 million. The rest of it is basically to create the new companies, and that's where we operate. The good thing that has started to happen in India is within the last 2 or 3 years, real exits have started to happen. Earlier what used to happen was the VCs would exit to each other. So, an early stage VC like us would exit out to a Tiger Global or to a Sequoia or to a SoftBank. But now what has started to happen is the traditional enterprises have started to acquire businesses. So Reliance spearheaded this over the last few years by making more than 17 acquisitions. Apart from that, we've had the Mahindras, we've had Jindal, we've had Marico, and of course, the other tech companies looking at the startup to make an acquisition. So I think the future for India in the startups is just in the early days beginning to pan out. And we see that scaling up very, very well. I think in this chart, if you see the constant growth of the startup community, the VC funding, I think 2016 and 2017, where there was a drop, is an extremely, extremely interesting years. Because for us, those 2 years were the time where the market matured. Those 2 years were the time when there was a drop in the madness and the froth within the ecosystem. So till 2015, you could do no wrong. And people were just signing checks as if there's no tomorrow. Startup founders were literally coming out from the woodworks. In 2016, investors realized that signing a check is the easiest thing to do in a startup. After signing a check, how do you get involved in the startup? How do you mentor a startup? How do you get the later rounds of funding? Those were the more critical aspects. And even founders realized that just by having an IIT tag or saying that I have a bright idea, you can't get a funding. So 2016-17 for me were the consolidation years, a lot of froth, like any new industry that gets created was out of the system. And a lot of matured investors started to come into the fray, and a lot of seasoned executives turned entrepreneurs who started to get into the startup. So 2018 onwards, we see a new wave of new matured companies, new matured investors, and now it is going in the right direction, growing constantly, but in a more positive and sanguine manner. I think this is a very, very interesting chart for a lot of people. This is compared, we don't have equivalent data because the industry is new within India, but this is comparing the US overall VC returns. This is a Cambridge Analytics data that which says on a 10-year period, constantly year on year, VC returns have beaten the S&P index. Obviously, the longer with a longer term view. This is there. Similar trend is there in UK as well, and we are working aggressively to get a trend like this for India. But I think by the end of this year, we will be starting to get a trend. I think a large number of things are happening in the AIF to category in the VCs to bring maturity. You know, most of you will know that just like mutual funds have CRISIL ratings, last year, for the first time under pressure from SEBI, CRISIL did a rating of all the AIFs, and they did it category wise, you know, for the VCs, private equities, hedge funds in a different categories. And happy to say that our performance had been in the literally in the top 0.1 percentile of the VC community. Another very interesting chart this is to see that even within the VC market, if you break it up to later stage VCs and early stage VCs, the early stage VC performance is better than the later stage VCs as well. So that is where Unicorn comes in. We are an early stage VC, and let's say someone like a Sequoia and all are later stage VC. So these are very interesting charts which shows the global trends, and I'm sure that's where the Indian cycle will also sort of follow. Again, another very, very interesting chart, which is a very different from, I would think, the mutual fund and other industries, is the nature of VCs is such that wherever there are founder-led VCs, wherever the main partners of the VCs are very, very involved, and they have not corporatized and got in, so to say, professional managers as VCs, the performance of the more individual-led VCs is better than the performance of more professional VCs, because the nature of the VC business is that you have to be literally living each company along with the founder. And in a way, as I keep saying, that although Unicorn is an investor, in our own way, we are also a startup. We are just 5 years old, do the same things that a startup does, raising our own money, investing that money, building up a team, building up a brand. So with that view, we have clearly see that new VC funds, where the founders themselves are involved in the day-to-day running, tend to perform better than established funds. So this, friends, I hope gives you an idea about where our view is of the COVID world. VCs as an asset class vis-a-vis India, and the overall VC as an asset class and how it has performed. I shall take some time quickly to give you a bit about Unicorn within this context. Unicorn. So we are now in a second fund. The first fund was a small fund. It was a 100 crore fund. We had a few, most of our, about 50% of our investment came from domestic institutional investors like SIDBI, LIC, Can Ventures, part of Canada Bank, and the Kerala government. Rest of it were family offices, and few were HNIs. You know, we've invested in totally 17 companies. 3 companies were write-offs. Uh, you know, 2 companies have had strategic acquisitions. As I said, our whole thing is about up rounds. We've had 8 companies up rounds, and of which there are 6 different companies at different stages. And as a fund, we are extremely involved with each of our companies, and we play a very aggressive role. We obviously don't run the companies, that's run by the entrepreneurs, but we are always working with them, providing strategic directions, etc. This is our fund two, where the broad structure is, you know, we have international investors coming in the US. You know, we have through a feeder structure in Mauritius, that feeds into the India AIF, and then Unicorn India Ventures, which is run by me and Anil, my partner. We are both the sponsor and the investment manager for the AIF fund. In the first fund, as I said, we have made the following investments, 3 write-offs, as you can see. Our overall NAV at this point in time is north of six times performance. We've got one company called Open Bank, which is going to give us about 35 times return in the present calculation. A couple of other winners are there. And this, as you will see, is a classical chart of what a VC looks like. There are failures where you get zero returns. In our case, we are lucky that it's only 3 out of 17. Usually the case is more. You know, in one company, we've got the money back. In one company, we had a 2x return. Most of the other companies, we feel the returns will be between 2 and 3x, except there'll be 3 or 4 companies which will literally give about 90% of the fund. And that's a classical VC investment. And, you know, to back this type of investment, our investment philosophy also fits in. So although 3 out of 17 companies have failed, that equates to only 5% of the investable capital. So when we put in the first check, we put in a small amount of money. As the companies keep growing, we keep investing more and more. Similarly, Open Bank, where in the last round, the valuation was about close to $250 million. We are the single biggest shareholder, holding 10% of the company by putting about $2 million. Again, that is because we went in early when the company was growing, put in the first money, and as they grew before the other big investors came in, took another bet and put in more money. So this classically, using the unicorn example, gives you an idea of how the VC cycle flows. This is some of the companies which we have invested. One of the big things in a VC world is to ensure that you sort of build your own ecosystem of investors. So we've done that. We've got international investors. We've got a large number of Indian investors, large funds, because this is very important. Both from a new company who comes to you in the fold, they must know that the larger funds are happy working with you. And the larger funds must also know that you have a strong deal flow and pipe, and you become a sort of forerunner for them as the companies grow. So I think that is a key job of an early stage fund, and we've been able to do that very successfully. This, as I told you, gives you an idea as to how fast the growth of a large, typically unicorn or to be a unicorn company usually is. And we've taken Open Bank as a case in point to give you an idea. So it had a valuation of 2.5 crores. You know, when the first round, at 13.5 crores when the first round happened, we came in over there. Then we, with a very small amount, then we again came in at 25 crore valuation. Then we doubled it up and came in at 132 crore valuation. And subsequently, when the big guys came, this whole grew. And all of this literally happened, if you see, in a space of about 2.5 years. So this classically represents the growth of the unicorn. And often when you read and see and hear that, you know, these companies in 3 years, 4 years have hit, you know, $1 billion valuation. Why is it? How come some other companies are not able to do it? This sort of reflects to you, you know, how the growth of a typical unicorn is. You know, this is something, again, just thought I would touch upon it. Why at this stage, at this time, it is very propitious to look at early stage as an asset class. As I said, post 2016, 17, the valuations have become rational and more and serious committed entrepreneurs are there. Uh, More and more focus is coming on profitability. Even if the company is loss making, that's fine, but the unit economics and path to profitability is something which has to be there. I touched upon this. More and more mature entrepreneurs have started to come. The average age in our first fund when we signed a check is 41 years, not 20 something or 30 something, which you tend to believe most startup founders are. These are people who worked 10, 15 years in the industry, solid experience, or second, third time entrepreneurs who want to do it. The increasing in exit opportunities, which I have already touched upon with Indian corporates now looking to start up, looking at acquisition of startups. The VC as an asset class is established today. I mean, most of the family offices today do keep an allocation for this asset class. We are seeing this more and more. Uh, Interesting thing that has happened over the last 4, 5 years, and again, that 16, 17, which I keep referring to as the watershed years. Earlier, people used to think, what's the big deal in investing in a fund? You know, Startups come directly to me, I can sign a check myself. They have now realized that that's not possible because you need a different maturity to run these companies, and more people have started to get out of angel investing and become investors in funds. Of course, there's a large government support, a large fund of fund has been created. SEBI, I think, is because I also am involved with the UK ecosystem. I think SEBI is absolutely stringent when it comes to reporting in the early stage, and much more than UK and US, where there is a sort of light touch in the VC market, unlike in India, where it is very, very regulated market. So I therefore think it's a very opportune time to look at AIFs, and within that, in particular, the early stage funds. So, again, a little bit about Unicorn. We have now established track record. We are committed to working closely with our investors. By my presence here and the fact we have another sidecar UK fund, we have understanding of the international market. And again, we work very, very closely with the founders. We don't leave them in the lurch. We don't believe that it's a portfolio approach where, okay, 5 companies die, it's fine, we will go ahead with it. I think that's a wrong approach, because being an entrepreneur myself, I know that every entrepreneur, for that entrepreneur, it is the only company he has, may not be for the fund. So till the end, we try to work out with the companies to see they succeed. This is basically broadly our track record in the second fund. We are looking to raise 400 crore. We have raised about 250 crores. We are investing in early stage businesses. Again, as I mentioned, doing it in various tranches. Initial tranche we do is 3 to 5 crores, and then we keep investing more and more in the businesses. The fund terms that we have is a classical fund term, 220 structure, 7 years fund. Again, this is another very, very interesting point, and not just pertaining to Unicorn. Although all the funds are seen as a locked fund for 7 years, most of the funds, including us, we take it over in tranches. So, the money keeps coming in tranches, and the trickle down start to happening from the 4th, 5th year onwards. So it's not entire money beginning and then you look at it after 7 years. So there's constant cash flow happening. Also, very, very interestingly, what has started to happen, and this is a question we always get asked by people who are looking into this asset classes: what if my personal circumstances change, and will I be able to get out before 7 years? So although the agreement you sign is for 7 years, as fund managers, we are not responsible for giving you an exit before 7 years. But there is a growing market within India, as is there in the West for a long time, of secondary investors. And these investors often, buy out individual investors who've been with the fund for 3, 4 years. For whatever reason, their personal circumstances change. They want to get out of this asset class. They're moving abroad. there are a whole bunch of people, and we can say from experience in the first fund that about 25% of our investors have churned out in the last 1 year because of COVID and changed in personal circumstances. They've made decent IRRs. The new coming investors who came in with secondaries got it at discount to NAV. So it was a win-win for everybody. So this has started to happen. So although the AIFs, and I can speak for Unicorn, we say it's a 7-year fund, investors do get an exit after a few years if they need to. So I think that is the crux of our broad investment. Just to give you an idea, and this is the last point I will take on before I just get onto the team is, a lot of people ask, how do you monitor the businesses? What is the type of due diligence you do? So this is the broad level of investment flow. We constantly are bombarded by deal flows. We receive more than 300 deals in a month. We obviously work on proprietary deals. We are one of those companies, because we have very good deal sourcing capability. We work on proprietary deals. We tend not to go with deals which are brought to us by bankers or intermediaries. We work with large number of incubation centers throughout India. Another very interesting aspect we have, and what we are seeing in the overall world within India, is that you think startups, you think NCR, Bangalore, and Mumbai, but more than 70-80%, which contribute more than 70-80% of the startups. But in our case, of the 25-26 companies we've invested in, not more than 7 or 8, maybe 10 at the maximum, are from these regions, because we go deep. We are seeing startups coming from Cochin, Trivandrum, Hyderabad, Pune, Jaipur, Ahmedabad, Bhilai. These are all places where we have invested, Goa. And I think that is where a lot of deal sourcing comes into the picture. After we source a deal, we do the due diligence, we pass it to an investment committee, which after approving a deal, we get into the detailed due diligence and deal structuring. And then comes the real work, which is the post-deal monitoring, what in our parlance is called venture management. And, I personally drive the venture management part of it. Most of the companies, we have a bunch of very senior people whom I'll touch upon, who are venture partners later. And a part of this is working towards giving an exit and a strategic return to the company. So Anil and Anil has been on the platform. My background has been said. So I've basically been an entrepreneur myself who's exited businesses, now turned into an investor. Anil compliments me because he's been an investor over the years, developed literally with a few of them in 2008, 9, 10, the entire early stage ecosystem through Mumbai Angels within India, deep connect and network within the Indian startup community. And our partnership therefore is full of complementarity and works very well for us. We have a unicorn team. The core team is people within the investment team, the community building, and the finance team. This is the core team of people who are, if you will, on the payrolls of the company. And along with this team, we've got associates and analysts. All of these guys are, typically the analysts, associates, and principals are guys who had either startup experience, but mostly from banks or large consultancies. And then we've got external IC members. We've got senior people from the financial services world, from academia, who are there as IC members. Everything has to be approved by the investment committee. We often have the lead fund of fund, the lead investor also sending IC observers from time to time. Then interestingly, what we have done, and this is where the interesting part is, we bring in very senior people from within the industry as industry advisors. These are people who put in monies in the fund, and so they're not just lending names, but more importantly, they work very, very closely with us in defining a thesis. Where medtech is going, where health tech is going, is something where Vedaish, who was the Glaxo managing director, works with us, or where the insurance world and consumer banking is going is something which Ashish, who was heading Citibank, and then Max Bupa, works with us on all of this. like this number of industry advisors. And that's how we sort of increase the team rather than the core team. We call upon experts to create a sort of ecosystem for us. So that in a nutshell is what the VC world is all about, and also where Unicorn sort of brings in, fits in. And you would have got a flavor of typically how the AIFs run using the Unicorn example. I'm more than happy to take any of your questions, please.
Sure. Thank you, Bhaskar. So audience, if you have any questions, please use the Ask a Question tab. I'll be happy to ask those questions to Bhaskar on your behalf. So till we get other questions, Bhaskar, there's one from me to you. How do you handle potentially competitive situations vis-a-vis your investee companies?
Potentially?
So when it comes to investments, how do you
Sure.
handle potentially competitive investment opportunities? Or
Yeah. So, one is it depends upon where the sector is. If the sector is very nascent and you don't know who the players are, then you would tend to invest in more than one within that sector. Uh, and then obviously you have all the good practices to ensure that you are not, you know, the standard conflicting between us. We don't have the same person sitting on both the companies, on the boards, and try to keep a Chinese wall between them. But once any of these companies sort of grow, and you know that we are backing this company within that part of the sector, then you don't tend to create another competition within the portfolio for that. So broadly, that's how we manage. And I think that's more or less what most people do. Some funds, and not us, they also have a spray and pray approach. They just go after a sector and say that, okay, within this sector I like, I don't know who the winner is. So while we would do maybe two companies, they would tend to do every company within that sector. I mean, not every, but 4 or 5 companies, waiting to see how that pans out. I think there are 1 or 2 funds even in India who are doing that spray and pray within the sector, but that's not us.
sure. One sec, I'll just check if there are some questions. So another question, other than the sectors that you're investing in through Unicorn, which are the other upcoming areas or other areas which you are very bullish about?
Yeah, we strongly believe in one area which is overarching, is this whole digitalization that is taking place in India. Across sectors. We stay away from consumer internet. We don't invest in front end companies. That is why we don't have any company in e-commerce, in delivery, in all of that. We fundamentally believe that whole of India, across industry, across sector, there's a massive move towards digitization. And we are investing in a lot of these back-end companies. I'll give you an example. There's a chit funds as an industry we all know has been existing for years. It has been a unique way of providing credit to the lower strata of the people. And, unfortunately, this industry, because it was not regulated, had got a bad name for itself, especially in Eastern India. What happens is in 2020 or 2019 end, the government regulated chit fund industry, brought it under the scope of RBI, and I think 2025 onwards, every chit fund has to be digital chit fund. So we invested in a company which is basically digitizing the back end of chit funds. So everything that a chit fund does, these guys are doing it online, GST payments, chit calculations, payment directly to individuals into their bank accounts, whichever way, but digitally into it. So, there is nothing new this company is doing, but this company is using technology to change the supply chain or change the value chain of a particular industry. So we strongly believe these are the type of companies which will do very well within India with a less calculated risk. And we are constantly looking for this type of companies, throughout, across industry verticals.
Sure. So there's a question from one of the participants here. Do you have investor onboard filter? And once an investor onboards, what is the process you follow? On reporting or follow for reporting?
So, so investor filter, yes, I mean, we do the usual thing because it's an AIF. The investor has to have the minimum size. The minimum ticket size is 1 crore in AIFs that know. So the natural filter is woven through that. The KYCs are there. These are all well documented processes. Every the information memorandum plus the contribution agreement are all a part of our SEBI documentation approved by SEBI. So that part is absolutely up there. And it's not just us. For every AIF, the same process is followed. Post that, from an investor reporting perspective, on a pure reporting, regulatory reporting, we send reports every 3 months. These reports are updates on the companies from the fund into which they have invested, and NAV calculation based on a mark-to-market basis of the companies. Classically, again, unlike the listed space, because these are private companies, it typically happens on a mark-to-market basis, i.e., whenever the last round happens, that's the valuation we stick at. So it's not a steady growth, but usually lumpy growth, stepped up growth. That's the way it happens. This we do on a quarterly basis. We have a total fund audit by Big Four every quarter, every year, which we send to the investors. From last year, again, another step that has come into the play, which we on a good basis did, based upon the auditor input, is once a year, we not only have audited report of the fund, but we have an external valuation report that goes alongside that. So the external valuation is done by an external valuer appointed by the auditor, and that also goes on an annual basis. So this is what it is. Two interesting things we have within the fund. Again, there are different types of LPs. Some LPs want to get involved and know a bit more. So as and when they have questions about particular companies, when will exits happen, we obviously answer them. There are some very LPs who are very hands-off LPs. To them, we don't bother them. But the good thing within our fund is we encourage LP participation in companies. So if there are investors who are coming into the funds, they say that we want to get a bit involved in a particular company, want to help grow a company, or want to pick and choose certain companies within your portfolio which we like. Can we invest? So we encourage that. Obviously, there are thresholds of investment and all of that, but this is something which we allow certain investors to have a say in, which most of the funds actually don't.
Sure. The next question, how do you see healthcare platforms?
I think we are very bullish on healthcare platforms. Again, I will give you an example of a portfolio company to drive the point. We have invested in a company called Neuro Equilibrium. Now it's called Future Health. The idea, the strategic objective of the company, if you will, is to use a platform to be able to provide specialized health by general practitioners. So let's take a hinterland India. In Moradabad, you have a general practitioner. How can he provide specialized help in, let's say, diabetes? So there are two verticals these guys have launched, and the idea is to keep launching multiple verticals. The first vertical they had launched was basically vertigo, ENT, neurology, all of that. And for that, they have a whole technology, hardware and software, which they go and put at various distribution points throughout India. They've got more than 100, maybe 120 now at various hospitals and general practitioners' clinics. These tests are done and the reports are all filtered back to a central pool of people who are all ENT specialists and neurologists who give this feedback on an ongoing basis. The second area where they went is in diabetes. Again, within diabetes, there are 7, 8 steps where you can do to prevent diabetes. That's the way they are again launching it. The interesting thing and why we are very bullish about medical platforms is, again, there is a change in the regulation. Earlier, what used to be said, legal position was only a doctor who has seen a patient can sign a prescription. Now the legal position is what they call one step removed. So today a doctor in Jaipur can sign a prescription for, let's say, diabetes to a patient in Madhya Pradesh, provided there is a local doctor who it goes to first. So this will, we see, this will broaden super specialization and other areas throughout Indian hinterland. Again, this falls very much in our thesis where we are not doing anything innovative, but using technology to create large-scale global, large-scale distribution and service delivery to individuals.
So the next question we have is, how do you evaluate a startup?
This, as I keep saying, is more an art than a science. Um, while we do, because again, it depends on, if you see the curve that I mentioned, it depends on, as a VC, which stage in the curve you are. If you are a later stage VC, then it is not very different from listed companies, where you get into company metrics, where you see where they stand vis-a-vis the other peer group, where you see how their performance is over the last few quarters, the cash conservation and the profitability. So later stage VC funding is not very dissimilar from the listed company space, but the early stage where we operate, it's a totally different ballgame. Here, obviously, it is so early, there is hardly any data in the companies to ratify. And that whatever data is there and whatever the business model is there, the company business model will drastically change over a period of time because the industry is not established. Obviously, on one hand, we do the natural due diligence, which is commercial due diligence of the customers, getting into the market, understanding the size of the market that is potential, of the financial and legal due diligence we do of the companies, all of that, the founder due diligence on the back. But the key thing, and especially for me and I play, is basically the quality of the founder and whether the founder has what it takes. And that is why I keep saying it's an art, not a science. We spend a lot of time with the founder before we sign a check. Even during COVID time, where you can't physically meet that often, we talk to them on a regular basis for 3 months, 4 months, understand their nature. We spend a lot of time on the family and to understand the family background of the person. It is extremely important to understand the family, because a lot of times what happens is, especially in young founders, they have an aspiration to grow the business, but when they come with a roadblock, they sort of leave it and say, I'll go and take up a job with Infosys, I'll go to Microsoft and join. So we spend a lot of time to understand the DNA of the entrepreneur. And for us as early stage founders, and for me, who's been a founder myself, and I want to get under the skin of the founder before we sign the check. So early stage investing is a different ball game, and yeah.
Sure. One sec. I'll go on to the next question. It reads, the person is asking, I see investments into VCs are in crores. Can any individual investor invest in smaller amounts, say a few lakhs? Is it possible for individuals to get into VC business as associates or distributors?
So one, no, you cannot invest in lakhs because the AIF setting is a crore. So that is very difficult unless at your level you do a pooled structure where 4 or 5 of you all pool in the money, and what eventually comes to the AIF is a minimum of a crore. Yes, I'm sure there are ways where you can become distributors or partners to any of the VC funds. And we work with a large number of partners like this who help propagate our fundraising effort and our story. And I think the distribution network for the VCs is just starting to happen within the country.
Sure. Okay. So guys, any other questions, please quickly share. There's one I see. I'm not sure what he's referring to, but it reads, you seem to be investing on lending platforms. Why not investment management platforms? So I'm not sure what's the
We have
difference.
not invested in lending platforms. Oh, okay. Maybe what he means is we have, as a VC, we have invested in a lending platform. We have invested in a company called SmartCoin, which is a lending platform.
Uh-huh.
We are looking at it. It's not that we don't invest in investment management, or we have looked at companies. We've not found any company where we would have taken an investment call within the investment management space. And there are a lot of very interesting companies which are there in technology investment management. Some of them are trying to use, artificial intelligence to do calculations. There's a lot of interesting things going on, but we have not yet taken a view.
Uh, Bhaskar, I mean, one question from my side. Of course, nowadays, one as an investor, you don't really need to invest only through a fund. I mean, you can also do it through a lot of these platforms, accelerators, etc. So, any suggestions you would like to give to investors, either of AIFs or such platforms,
Yeah,
to some do's and don'ts before investing into a startup?
yeah, it's a great question actually. In the startup business, you may be lucky. It's almost like a lottery chance if you think that you make two investments or three investments and you'll make money. You have to look at it. You have, because again, you are going in very early, and that's the only time you can invest. You can't invest after the business model is established, because by that time the more VCs would have come into the play, and they will not allow any individual investor to come in. So the only way you can enter this world is to go in early. Now, if you go in early, you must have a concerted strategy. What we say typically is, if you see whatever, if you want to do a small investment of, let's say, 20 lakhs a year, but then you'll have to do that 20 lakhs consistently over a 3-year period. And that 20 lakhs again has to be divided, let's say, every year in, let's say, 4 companies. So, you do 4 companies, 5 lakhs each over a 3-year period, then or a 4-year period, you sort of build up, your portfolio of 16 to 20 companies. That's when you'll see the winners coming through. So it can't be a one-off thing that you meet some good guy on the road and maybe he's very good, or someone says my friend's son is doing a business, he's an amazing guy, he's from IIT, he's from MIT, brilliant idea, I'll go and invest. That's not the way to build your portfolio. It has to be a portfolio approach, thought through. You can do it, you can be a part of angel networks. There are some angel networks, some incubators, or you can be a part of a fund with us. But again, the ticket size for becoming a investor is a crore.
Yeah, just a sec. I'll just quickly see if there's any question. Guys, we have time only for one or max 2 questions. So if you have something, please share. Um, okay, good question here. What are the necessary set of skills one might require in the world of venture capital?
I think
I mean, I'm assuming he's talking from the fund point of view. Someone wants to run a fund, venture capital fund.
yeah. So or someone wants to join a venture capital fund, whatever. I think you must be able to take risks yourself. You must, again, there's a clear difference between a later stage and early stage. A later stage VC fund or a private equity fund, you need much more analytical skills. You need to have a consulting view about industries. That's what it is. I'm talking of the early stage where we operate. There you must yourself be an entrepreneur of sorts, in the sense you must be able to take a bet on a particular industry, and you must have a view. The view may go wrong, but you cannot hedge your bets. A lot of people in the early who come to the early stage from later stage, because they don't take a view, years will pass and they will only do a couple of investments. Investments will go wrong, but you have to have a view and start investing in the early stage. So one is that you have to be yourself an entrepreneur, take risks, make investments. Two is you must have the empathy and understand your entrepreneur, because we going so early, we are backing entrepreneurs. I can give you a small example. There was an entrepreneur we had, very sharp or 100% committed to the business. But one thing he would never do was his business plan for the next round. And he always needed funding. So every board meeting, we would ask him, when are you doing the business plan? He would not. Till once I went down to Bangalore, sat him down over a lunch, over a dinner, and asked him what the issue is. And I had realized it rightly. The issue was very simple. He was so busy running his shop, he did not have the time. That's it. And he did not say it upfront because he felt, that how can I say it in a board meeting? So we sent one person from our VC team, sat down there for 3 weeks, took download from this guy's head an hour or two a day, and made the plan. So you'll have to have that empathy in that early stage to understand your entrepreneur. Otherwise, you will never be able to succeed. And third, of course, as a VC, you'd be able to have the other things. It's a very tough industry, dog eat dog industry. So you must be out and about, build your own network, which is extremely important. Understand technology. If you're a tech investor, you cannot be a pure financial person trying to get into the VC world, tech VC world. You have to understand. You may not be able to do the coding, but you have to understand and appreciate technology. So these are some of the broad things that you have to do.
Any views on the edtech segment right now?
I think edtech is an area which we as a fund missed out because what happened in edtech is extremely interesting. India edtech has been going on, bumming along actually for the last 8-10 years, and nothing was happening. So people had become very, very skeptical to edtech. All of a sudden, within a matter of 2 years, the edtech industry in India just grew rampantly. And today there can be no more new edtechs coming into the play. It will only be now in industry of consolidation. And the 2 or 3 huge guys are there. They will keep on acquiring and become bigger. So therefore, now we realize that edtech is gone for us, especially on the content side of edtech. We might look, and we are looking at peripheral areas of edtech where we can do, like test, not content for the test, but testing platforms and other areas. But yeah, so edtech is a hot area, but the content of edtech, according to me, is done and dusted. New guys, new huge winners won't come. It's an industry at a state of consolidation, similar to e-commerce, similar to delivery, all of that.
Sure. So the last question here is, how can someone make you invest in his company?
I think, as I said, it should be an area which is a fit for us. If a founder is brilliant, the idea is brilliant, but if it's a consumer business, we will not look at it because we don't do consumer and we don't have the DNA for a consumer to invest and be an investor in a consumer company. So one, the fit should be right. And as I said, we do digital businesses using the digital growth of India. Second, of course, the full business plan we have to vet. But again, coming back to the main point, it has to be the face-to-face interaction with the founder, understanding the founder, understanding the DNA of the founder. I think that is where it all boils down to for us.